mic'd, I'll introduce them, but this is actually slightly conscious for those of you who've been to a lot of different panels and events in Washington, around the country. Particularly in Washington, I think we often have the regulators go first and industry go second. And kind of part of a little hidden gem in here was the idea that we'd have the industry go first so that we could then have the government and regulators respond. I'm going to start by introducing folks as they get mic'd up. My good friend and former colleague Jonathan Miller is to my left. Jonathan is Deputy Director of Consumer Protection and Data and Research at the FDIC. Previously, he served as a senior staff member on the Senate Banking, Housing, and Urban Affairs Committee, where he served Senators Dodd, Sarbanes, Kerry, many others, a graduate of Georgetown and Harvard. We're really pleased to have Jonathan with us today. To Jonathan's left is Adrienne Harris. Adrienne has one of the coolest jobs in Washington. She is a special assistant to the President of the United States. She serves at the NEC, where she serves our country and has been the leader on Fintech, helped host a White House Fintech event for those of you who were there. Prior to joining the White House, she worked at Sullivan & Cromwell. She clerked for the Southern District of New York and has a distinguished legal career and also a public service career, having worked for governors in New York, politicians in New Jersey, and now we're blessed to have her working for all of us in the White House. Last, but certainly not least, is Anjan Mukherjee. Anjan is Deputy Assistant Secretary of the Treasury and Counselor to the Secretary. Prior to joining that, he served at Blackstone, where he was a senior investment banker. And then you had a stint in the Clinton department in the education, in the Clinton administration. So really, models of public service going in and out of government and the private sector. So with this distinguished panel, I thought we'd start off, and the great thing about having regulators on the panel is that they're data-driven and have resources to actually get data and information. So I thought we'd kind of go down and let everybody talk a little bit about the data and what they've seen from their actual time studying this issue. Jonathan, should we kick it off with you?
Yeah. So will they?
Yeah.
And will be up behind me, or?
Yep.
Okay, so Aaron, thank you very much for the kind introduction, and to Brookings for putting on a really interesting panel. Enjoyed it. I learn something every time I do this. So I'm going to talk to you today about MFS for the little guy, so to speak, to make it work for all working Americans. And I'm going to talk to you today a little bit about our qualitative research, the focus groups we did with underserved consumers, exactly the kinds of folks that you heard discussed quite a bit. So the FDIC has, as one of its core missions, the goal of expanding economic inclusion for the underserved. And when we say expand economic inclusion, we really mean bringing them into the banking system. Maybe a little old-fashioned from the previous panel, but that to us is where we really want our households, our American consumers, to be. So this is a key focus for the FDIC. We do a lot of our work in conjunction with a federal advisory committee called the Committee on Economic Inclusion, a very diverse and interesting group. It's the focus of a lot of our consumer research. This is one piece. Another piece, which will be released next week, a week from today, as a matter of fact, is our biennial household survey on the un- and underbanked, which is really a treasure trove of quantitative data. And we also have offered a series of practical demonstration programs. For example, we've done a safe transaction account template, which I think we heard the question about the veterans and the fees that they suffer in the banking system, an effort to create a transaction account that helps people avoid those kinds of fees. And in fact, that template has now been adopted by a large number of very large institutions, is widely available. So the focus of this particular qualitative research we did, the hypothesis is that really we think mobile financial services, MFS, are uniquely positioned to address some of the needs that underserved consumers have in the financial system, and thereby will be able to contribute meaningfully to more sustainable banking relationships. So this is just a little bit of the research methodology. This is all available on economicinclusion.gov. All our data is on economicinclusion.gov, all the specific census data and the qualitative research data, et cetera. So I'll skip over the methods slide. And this is really briefly what we found. Sort of what we heard from our consumers is they think of their needs in that first column in sort of along 7 dimensions. You can read them out there. You can see long-term financial management through access to money. And the second column then is their perceptions as to how they see banks meeting those needs. And you can see on some of the key areas, control, convenience, affordability, and access to money, banks are seen as very weak in meeting those needs for consumers. And then the last column, I guess I'm pointing in the wrong direction. Yeah. So in the last column, you see the same sets of consumers' views of how mobile financial services compare as a channel for meeting those needs compared to the other options they have. And you can see on those crucial, crucial needs, consumer, control, convenience, and affordability in particular, they see that as really as superior. And I'm going to talk a little bit more about that. So what you see here in slide 4 is that mobile financial services really have a positive impact on 3 of the most important functions that underserved consumers, low and moderate income consumers have, and the needs they have from the financial system: affordability, control, and convenience. So control. They recognize that MFS can help them increase their sense of control through greater access to account information. We've talked about this. Through mechanisms such as automated balance alerts and up-to-date transaction histories. Convenience. Low and moderate income consumers, consumers living paycheck to paycheck, put a premium on their time and their effort. And anything that can save them the time, save them effort, is really value added to them. It's really meaningful to them. And they see MFS, and in fact, MFS is an effective way of saving time and effort. And finally, affordability. The kind of transparency, the kind of access to account information can really help consumers avoid fees that we've been discussing. Now, just to back up for a quick second, there are other areas where banks are seen as strong. I'll talk a little bit more about that. But an area that we heard Aaron get a little passionate about, access to money. This continues to be a real frustration for low and moderate income consumers who are living paycheck to paycheck. Part of it is, and to a certain extent, the MFS is helpful, but not sufficiently so. So this is an area where I think we all need to do a little bit of work, and I think the effort to make the payment system much more responsive would be very important. MFS can deliver the information timely to the consumers, but and I'll talk about that in a second. But the information, the data is not yet timely, and that's what an improvement in the payment system will get to. So strategies to improve economic inclusion through MFS. This is really the core of the work that we do. So 1, increase consumer control over finances by improving access to timely account information. So it's not just the timeliness of the information, particularly until the payment system gets fixed, it's the ease of understanding, the accuracy of the information. So this woman decides to put her check in because she can afford to wait till Wednesday. It'll show up on her account. She looks at her phone, she sees what it is. Well, does it tell her exactly the day that the cash, that the money is available to her, or does it make it look like she's got money in her account that then she writes a check or she swipes and it turns out not to be there? So it's both make it easy to understand as well as timely. Expedite access to money, we talked about that. That's really, I can't underscore that, the importance of that enough. These, again, paycheck to paycheck, they put a paycheck or another a credit into their account, they need access to that money. And they're willing, by the way, to see their money go out faster as well, as long as they know what's in and what's out, really in and out. Third, making banking more affordable through better account management, alerts, low balance alerts, very important, very useful, actionable in real time. That's really important to them. They want to know while they're online at Target, can I afford to buy this? It informs their spot decisions, and it can be incredibly useful to them. Address real and perceived security shortfalls. They hear about hacking. They get very concerned about this. A lot of their concerns are probably may not be accurate, but that's part of the educational process that banks have to do. Many institutions have these tools available. Unfortunately, some of their account holders don't know what's available to them. So increase awareness of mobile tools, setting up mobile accounts when you open the account with somebody is probably a way to expedite that. And finally, encourage long-term financial management. This is an area where banks already have a competitive advantage. This segment of the population sees banks as very strong in this area, delivering longer-term tools to help people manage their finances into the future. For example, encouraging savings. We heard some about that. Just real-time, just-in-time education decisions that help set them up in the future. Those are the kinds of strategies we think banks can follow. And the end result of this, we hope, is far more sustainable relationships between this group, paycheck-to-paycheck consumers, which I didn't realize was 75% of the households, and their financial institutions.
Great, thank you, Jonathan. Adrian?
There's, well, so many good things that Jonathan hit on that I want to build on as well, and thanks for having me. And it's good to see lots of familiar faces in the audience, although the one drawback to this community and how tight it is that when I see people who I owe emails to, it makes me turn my head like this. So I think, there's been a lot of themes I think that Senator Warren, or that Warner hit on, and Jonathan hit on, and the first panel hit on, and I just want to talk about two of those. The first is, it's very expensive to be poor, right? You hit on it in your story. Some of my friends in the audience who've probably heard me say this too many times have heard me tell the story of a woman named Jane and take the audience through the first 15 days of her month and how much Jane will spend just to have access to her own money. And it's a significant portion of her income. And some of that is just that financial services are not meeting the needs of consumers. And some of it is just an old financial architecture, I think all of which now we have the tools to remedy and improve. The other thing, that some of Jonathan's remarks and others is, we talk a lot about financial literacy and education and protecting consumers from predatory products, which are all good things. But I often like to remind people, nobody understands money better than poor people, right? To your point, it doesn't matter to you if your check hits on Wednesday or Monday. There's money there. But for people who are paycheck to paycheck or very low income, often they know, right, when their check is going to hit and when the withdrawal they made is going to hit their account. And they know that cashing a check at Walmart costs $3 versus the check casher on the corner, that's $5. And these are all insights I think we would do well to incorporate into our policy making, into product development, whatever it is. And the insights that Jonathan brought up and others, I think, inform that very well. So all of this talk that we have about fintech, I think, whether it's from consumer-facing innovations or systemic innovations, I think should really keep those things in mind. It's very much what Quentin was saying, right? You sort of start with the end in mind, start with the consumer in mind. Even if you're thinking about an institutional innovation, it should really be about the ultimate consumer. And how is what you're doing, if you're a regulator, a policymaker, a private sector entity, how is it serving those ends? And it was so funny to me when the senator mentioned the social contract. It made me actually think about my law school application, which I wrote all about the social contract and how going to law school for me was about learning the social contract from a government point of view, but also thinking about, because I've always had an interest in business and financial services, what does a social contract mean in a business sense? And financial services is such an interesting place to think about the social contract from a social point of view and from a government point of view, as well as from a business point of view. It's such a great place to think about the intersection of those things and how financial services and for-profit entities in financial services serve these broader social ends. And a lot of what we talked about at the Fintech Summit in June was just that. What does Fintech mean for these broader social policy goals that we care about? What does Fintech mean for access to credit for small businesses? What does Fintech mean for income smoothing? What does Fintech mean for financial inclusion and financial health? Maybe you are actually pretty well off from the sense that your income maybe far exceeds your expenses, but it doesn't mean you're necessarily financially healthy. How can Fintech help with that? We talked about Fintech and sort of economic competitiveness for the country, right? So there are all these other things we care about, and financial services in a lot of ways is at the foundation of that. And as we think about Fintech and the evolution of financial services more broadly, like these are all the things that we should be thinking about, whether we're regulators or policymakers or people in industry. So I thought that was so interesting that he brought up the social contract. It really warmed my heart. The other thing I just want to hit on a little bit is, Jonathan mentioned spot decisions. And as we think about all these innovations in financial services, and there's any number of products now that have made it easier for people to save or manage their money, but there are lots of products that make it easier for people to spend, right? It used to be that you would take cash and coin out of your wallet or out of your pocket, and like you had a very tangible sense of the money that you were spending, and if the thing that you were getting in return was worth the number of bills you were counting out. The same was true when you would be at a cash register writing checks. It became slightly less true when it was just a card that you were swiping, less true still when you're sort of tapping your phone. And now as people sort of talk about geolocation in payments, right? My phone knows that I am in a place, and I sort of pick up an item, and you can walk out the door and pay for it without touching anything at all, right? The Uber sort of experience. How are we helping people think about money and the way they're spending money, right? We're making it so much easier to engage in transactions, but we haven't much changed the way we teach people about money. In this environment where it's just so much easier to move money and manage money. So the spot decisions to me is something that's really important because and regardless of your income or your socioeconomic status, right? I sort of dream about the day where there's a product, hint over here to my friends, where I'd walk into a store and my phone would, I'm in the grocery store and my phone would say, Adrian, you typically spend $200 in the grocery store. If you spent $150, and for me, that probably means like no Oreos and no tortilla chips or all the horrible things that I eat all the time. You can, like, if you save $50 and take $30 and put it in this 529 and $20 and put it toward your credit card, and with all the appropriate sort of disclosures and protections, like if you would go ahead and put the Oreos back, but contribute to your 529 and put your thumbprint on the phone, right? I mean, that sort of education and innovation, I think, getting consumers at the point where they're making a decision, and again, regardless of your place on the income spectrum, are the kind of things I think are really exciting to me in the context of all the things that you've talked about before, consumer protection, systemic protections, and the like. So I think, as we watch this space evolve, again, for me, it just goes back to who is the consumer for any given sort of product or service? What is it? What sort of ends do we want them to be able to meet, or objectives do we want to serve for them? And then taking it up a little bit, what are sort of the social ends that we want to be able to serve through helping these consumers reach their financial goals? And as I think about my job as a policymaker and how we think about Fintech and how we engage with stakeholders in the ecosystem, those are always sort of the questions that inform my dialogues with people.
I think I just saw Nadeem and Earn Up start thinking through what the app is to get the Oreos into paying down your student loans.
Yeah, exactly.
I'll take the Oreo.
Yeah.
Amjad?
I was just going to say, that was a pretty good elevator pitch, so we'll start working on that business plan.
Exactly.
I'll help
January.
you out. Exactly. Well, thank you. You sure you don't have a draft already? On your free time.
Yeah.
Well, thank you, Aaron, for having me here as well as part of obviously a very important discussion that you're organizing here today. I wanted to hit on a lot of the themes that Jonathan and Adrian just mentioned through the lens, maybe a narrow lens, segment of the fintech world that we at Treasury have been doing a deeper dive in, namely on online marketplace lending. And then I'd love after that, as we get into the conversation, to broaden out. We at Treasury, we're doing a lot of work on financial inclusion and literacy, we're finding ways to expand access to credit. I hope we get a chance to talk about all of that. But I wanted to use my opening time here as maybe a little commercial for the work we've been doing on marketplace lending. We put out a white paper recently here, and hopefully we have copies here. Hopefully you all will take one home with you and take a look at it. You know, at Treasury, we, as you've heard some of our other agencies describing, we're essentially interested in ways to foster the growth of innovation, safe and responsible innovation, and find ways to expand access to credit. And we found that marketplace lending was potentially an emerging area of interest in that regard. And so we decided to do a little bit of work on this. We issued a request for information in July of last year. And received a tremendous amount of comment on the growth of the industry from a whole variety of stakeholders, borrowers and lenders and investors and policymakers. And we have sort of compiled that work in the form of this report, which we published just a few months ago in May. And I thought what I could do is touch on a few of the themes that emerged from this report, as well as a few of the recommendations, and some of the themes and recommendations will hit on the broader themes I think we're talking about here in FinTech today around data, access to credit, some of the risks, et cetera. So just to very quickly go through the themes, and this is laid out in our report. First thing I wanted to mention is that commenters really remarked that the use of data and modeling techniques for underwriting represents both an innovation and a risk. So that the emerging data-driven algorithms that many platform lenders are utilizing could well actually expedite credit assessments and make credit available faster, which is a good thing, and reduce cost and pass those reduced costs on to the borrower in the form of lower rates, which is also a good thing, but also carry risks. So algorithms, just because a result spits out of an algorithm, it doesn't mean it's perfect. It could result in unintended correlations or disparate impacts, or fair lending type concerns. So that was one observation that commenters had. Second, that there's clearly there's an opportunity to expand access to credit. We see that more on the small business side than on the consumer side. At the moment, most of the activity in platform lending on the consumer side is focused on the prime part of the credit spectrum and is really more about debt consolidation. But on the small business side, that there really is an opportunity to expand credit there. As most of you are aware, coming out of the crisis, small business lending has not picked up in the same way as lending to larger businesses has. In fact, if you look at commercial and industrial loans issued under $1 million, they've essentially been flat, slightly down since their peak level in 2008. Whereas C&I loans above $1 million have grown about 10 or 11% over that period of time. So there are structural issues affecting the small business lending market, and marketplace lending offers an opportunity to address that to some extent. Third theme that emerged was that these new credit models remain untested. A lot of these businesses obviously have emerged in relatively benign credit environments and should really be tested through a credit cycle. And as delinquency rates or charge-off rates start to increase, that obviously bears monitoring. Fourth, we found that, or commenters remarked that small business borrowers will likely require enhanced safeguards. And so the suite of consumer protections that exist, the CFPB has done a great job in really promulgating those. Those analogous protections don't necessarily all exist for small business borrowers. And so the need for greater transparency in that area was observed. Transparency in general was an observation that many commenters made. The need for greater pricing transparency, the need for greater transparency around standardization of pricing and rates. And then the last two themes, one is that the secondary market for loans is relatively undeveloped. The securitization market, or the back-end markets for a lot of these for a lot of this activity, while growing, is still relatively nascent. And finally, commenters remarked that regulatory clarity could really benefit the market, and that the government could play a very important role in helping drive the growth here, but that there could be additional clarity provided around the roles and requirements for the various market participants. So I just wanted to make very clear what some of the, we received over 100 comments, and we kind of bucketed them in those themes. Now, to turn to some of the recommendations that, we did a lot of outreach and thinking on our posture in this space, and so I just wanted to hit on a few of the key recommendations that we made in the context of marketplace lending. First is that, again, obviously these all come right out of the themes that I just talked about. First is that we support more robust small business borrower protections and would frankly support legislation to achieve that end. Second, that marketplace lenders really should provide strong customer service across the entire value chain, from origination all the way to the back end of repayment or even collections if that becomes relevant, and that appropriate contractual or other mechanisms should really be put in place to align the interests of borrowers and investors better. Third, on the theme of transparency, we really like the idea and would promote the idea of creating a sort of a private sector-driven registry for tracking data in this area, and this could be broadly, this could be broadened out to other fintech products. In marketplace lending in particular, on transactions, on issuances, securitization volumes, on loan level performance data, all of that I think would benefit the industry and benefit the public, borrowers. Fourth recommendation was that, for this technology really to have quickly expand access on the consumer side, which, as I remarked earlier, is at the moment primarily focused on the prime side of the credit spectrum. It's important to somehow get to those consumers who are not as easily scorable under traditional credit scoring models, the thin client or the thin file or no file type consumers. And one way to do this is for marketplace lending or online platforms to partner with, for example, community development financial institutions, CDFIs, which for decades have been serving these populations. And you can imagine a partnership between these two types of organizations where the algorithms and the sort of the efficiencies that a marketplace lender could bring is married up with the intimate sort of knowledge of the communities that the CDFIs serve in a way that distressed community credit consumers can open up. Fifth, as is discussed earlier around the IRS and in other contexts, we're very supportive of exploring innovative ways to access the data that the government has. Obviously, this administration has been a huge proponent through the Open Government Initiative of this type of effort to make data more accessible to entrepreneurs and innovators and others, to really develop new products and services. And in the context of this particular industry, I think it could be very important and helpful to help drive the borrower experience and create safer and more accurate loan products. And then finally, parallel to the last theme I talked about, what we're doing at Treasury is facilitating interagency coordination in marketplace lending through the creation of a standing interagency working group for the sector. And the purpose of this group is initially really just information sharing and sharing best practices, but it also enables the member agencies of this group to identify areas where additional regulatory clarity may be warranted. So I just wanted to take a moment to kind of give you a lay of the land of the kind of the work we've been doing in marketplace lending. We obviously continue to very carefully monitor the industry, and happy, Aaron, to kind of expand the conversation beyond that.
I thank you, John, and from my time in government and then my time outside looking at it, coordinating the various regulators is a yeoman's task that often seeds great work that is fully underappreciated, because a few things drive me more angry than when regulators go in opposite directions, creating the kind of uncertainty that the first panel said, slows down innovation. So each of you has brought up some really, really good points. And I kind of want to put you on the spot a little bit to think across these different streams and topics to answer the question of where do you see the single greatest promise for fintech to improve the lives for working Americans, and why, how, and how will it happen? And the things I've heard discussed are real-time payments, more and better access to capital for small businesses, lowering rates through improved underwriting, broader availability of credit in that kind of thin or low file, real-time information to allow decision-making on the spot, and probably a couple other have been brought up, more appropriate information. So what is the single greatest promise for fintech to actually affect working Americans?
So I would say, from the point of view of the focus groups that we did, is real-time payments. I mean, it is an enormous frustration for working people who are living paycheck to paycheck not to know exactly what amount of money is in their account at any particular point in time. And again, like I said, they're willing to pay. For example, mobile RDC. The picture version of your check deposit.
Remote check deposit.
Right, remote check deposit capture. They're willing to pay a modest fee to have immediate access to the funds, to have real funds. So again, just because for these folks, time and effort is crucial, and the effort of trying to figure out, all right, this check doesn't clear till Wednesday, so I'm going to pay this bill. So if I pay this bill tomorrow, I'll probably be okay, et cetera, et cetera. So I would say real-time payments, which I think is coming, but the faster that gets here, I think the more the better service to the people we're talking about.
Yeah, I would say, I think it's hard to pick a silver bullet, but I think that one is such a good one. The faster payments is such a good one, because you have people who, I think you pointed out, their income exceeds their expenses, but it's these timing gaps that send them to the predatory service providers, or maybe even not predatory, but expensive service providers. And that, I think, the real-time payments just has the ability to solve for so many things, and it's not necessarily a flashy new product, it's just improving infrastructure.
I think we can all be in agreement on this one, but you asked us to pick two, right? So
There you go.
I agree with them wholeheartedly on the faster payments and the value there. I mean, you think about things like real-time payroll products that are emerging, which can be so valuable to the consumer in having access to that cash on a real-time basis and not having to go out and make a 2-week short-term installment loan or something to tide them over. But I think that, I touched upon access to small business, but I mean, I think, Aaron, the other obvious, I think, high impact area is just expanding access to the consumer base, if we can get there through, notwithstanding the risks that I talked about. But, the theory of the case is that more data, better data analytics will be able to drive lower costs, better credit decisions, and therefore be able to maybe get at some of these thinner, no-file customers. Again, it's aspirational to some extent now, but again, it's an aspiration that we hope we can support, and I think could have real impact. So that would be the other area. There's one that you didn't mention, which I think is also important, which is security. Because from a wholesale financial services perspective, that's very important. But just from the consumer lens that we're talking about today, boy, I mean, we read about in the papers all the time, these breaches, people's credit card information stolen, or some of the health insurers have been breached, and PII, personally identifiable information in terms of health records, which is really sensitive stuff, gets out there. And if you think about the way the internet was developed, it was developed to focus on connectivity and interoperability. Those are features that were embedded into the design of the internet. Security was not, right? And technology has an ability to change that as we think about re-architecting these systems to embed security in a way that consumers' valuable and sensitive information is protected.
So let me pick up on that security point, because I think there are a couple things, right? Like, first, when you think about, there's this kind of unique moment where we've moved from this, security is cultural in a way, right? In America, we give away our credit card. We don't allow line of sight. We put it in the bill and the waitress takes it away, right? In Europe, that never happens. In Europe, they have hardcore, you got to hold your credit card at all time. They have chip and pin, right? In the US, we've managed to, in my opinion, land in the worst of all situations, which is chip, no pin. So it's no more secure, it's twice as long, and it's just a horrible change of which I see very little value add. At the same time, you have phones with thumbprint technology, which has to be far more valuable. I mean, I've signed all sorts of crazy stuff in the credit card line, in the check. That doesn't seem to matter what you sign. But your thumbprint, I don't quite understand why with Apple Pay sometimes you still have to sign. I mean, they've gotten your thumbprint. I've never been turned down because my signature didn't match the back of my card. But like...
He doesn't even sign his own name.
Yeah, well... the question about where's our legal and regulatory system ready for fintech is where I'm going with this, with security. Because there are aspects of the security system in fintech where you go back in the history of magstripe, which is the technology that underlines credit, debit, and prepaid. And when you really do a deep dive, you come down to this seminal bill called the Electronic Funds Transfer Act, passed in the 1970s, with this new questionable technology about debit card that had this great liability question. And since we're at Brookings in the home of economic studies, I'll start with the Coase theorem. A famous Nobel laureate, Ronald Coase from the University of Chicago, who said the role of government is to assign property rights and then get out of the way. And I think of EFTA as this great example of that, where the government assigned the property right of liability, that is what happens if your card is hacked or stolen, assigned a very limited amount to the consumer, $500, and all the rest to the banking industry, and said, banks, if you want to have this new technology of debit cards and ATMs, you fix the liability because we've clearly assigned it to you. And lo and behold, consumers adopted the technology because they knew it was secure. Banks figured out the solution. I mean, I think if we didn't have EFTA today and we proposed it, you'd be laughed out of the room for putting all that liability on industry, yet it's worked wonderfully. I think the Bureau did a fantastic job in their prepaid rule, fundamentally not only extending the EFTA regulatory structure of the 70s to prepaid cards, which is kind of a huge innovation, but fundamentally the same technology, but then applied it to PayPal. And applied it previously, your PayPal balance, if you fat-fingered an email, was totally unprotected. If it went through a debit or credit card, it was protected through this regulation. But PayPal to PayPal, totally out there. And this is an example to me of how government regulation can modernize the existing structure without going back to Congress to extend it. What I guess I want to ask Anjan is kind of like where you think, first of all, do you kind of agree with that framework? And second off, through the interagency working group, through Treasury, where is it that you think you guys can start looking at that legal regulatory structure, apply it to marketplace lending to let that space flourish, or other areas within the existing legal authority?
Well, I think it's a great question. I think obviously we live in a world where we have in the U.S. A relatively fragmented regulatory environment for the financial sector with independent regulatory agencies, and I underscore the word independent. So what we do at Treasury, or we can try to do, is serve a convening and facilitating function, right? So the idea would be, as I mentioned at the very outset, we are trying ways to, I think our role is to find ways to foster innovation in a way that supports our policy objectives around expanding access to credit, supporting privacy rights, and so on and so forth relative to this discussion, and cracking down on it when that innovation is actually running afoul of those objectives or law. And through this interagency working group, again, as I mentioned, if we do this right, we will find ways to make clear to industry, as to some of the comments we've heard earlier, what exactly where the obligations are and where we can to streamline, right, or to encourage streamlining. Just to broaden the answer out a little bit, I think government can play, I think, a really important role as a facilitator or an initiator. And in some cases also plays a role as sort of a product producer to prime the pump, right? So let me give you a few examples. On the facilitation side, we all said that faster payments is more important. So the Fed has stood up this faster payments task force, which is, everyone should look this up if they have a great website, fedimprovepayments.org, I think it's called. So there's a faster payments task force and a secure payments task force, both on the themes that we're hitting on here, which is security as well as speed. And this is a very broad public-private partnership. The faster payments task force has something like 300 participants, public sector, private sector, large institutions, small institutions, well represented. They've come up with a series of criteria, 36 different criteria, and what they're trying to do is literally re-architect and revamp the payment system. And obviously the Fed, the Fed sits on our critical payment infrastructure, manages it. And so they're very focused on these issues that we're talking about today. In fact, last week they took in about 20 proposals from the private sector that are meant to hit all those criteria, such as, they haven't been fully public on all of this, but the things they have been public on, they've said, that when the payment recipient receive funds, they will have 30 minutes to access it. The system's got to be open 24 hours a day, the amount of information that goes along with sending a payment should be minimal, shouldn't have to show up with my birth certificate and so on and so forth, right? So how do we make things more efficient? Same on the security side. So there's an important convening function that I think will ultimately drive, one of the other criteria is starting implementation by 2019. So this is not decades away, right?
Well,
so that's one example of facilitating. In terms of originating, if you look at Treasury, we oversee the Direct Express program, where there are disbursements of benefits, Social Security and veterans benefits that are put directly onto a prepaid card, and there are 5 million people that have this card, and many of them are unbanked or underbanked, right? So this is providing a real service. We just actually rolled out a mobile app that allows for real-time account balances in that program, and roughly half of that 5 million, from what I understand, actually have the mobile app and use it. So in that way, the government can actually serve as an example of the kinds of products that they would also be promoting. So there are many other examples we can talk about, so just to broaden it out, beyond regulatory clarity, there's a facilitating function and also sort of an originating function, I think, that could be played.
Yeah, I think, I would underscore what Anjan said. I mean, and I think there's convening in two senses, which he's touched on. A lot of folks in this room know, right? They'll come to events like the Financial Inclusion Forum that Treasury had, or the Fintech Forum at the White House. There's that physical convening, but the marketplace lending white paper is another sort of convening and facilitating that government can do, right? It's hard to find another entity that can solicit input from a broad ecosystem, right? Digest it, package it, and put it back out for the ecosystem in an authoritative and clear way. I think it's an incredibly important function. Similarly, on the operational side, which Anjan also touched on, I think, whatever your feelings about chip and pin or chip and signature, right? I mean, it's the government was able to do that with its cards, as the private sector was still, and it set the example. Right?
So I'll address just the EFTA example, which I agree with you is a terrific example. So I think it's sort of important to distinguish the method of delivery of a product from the product itself. So what the CFPB, I think, concluded was whether your prepaid account is on a card or on your phone, it doesn't really matter. It's still subject to the modality by which it's delivered isn't so important. It's the nature of the product itself. Likewise with online lending. I mean, all the same requirements apply to online lending, even though it may be delivered purely electronically. You're not sitting in a bank, filling out an application and so forth. So I think I'm not sure we've yet been really confronted with a product that's a lot different than the kinds of products we've had. Mostly it's the way those products have been delivered that's changed. And so I think you have to look reasonably at whatever the governing regulation is and seeing how it applies in those situations.
Yeah, no, I think you're right in that space, and then having the courage and speed to actually go and implement the regs so the rest of the world sees it. We keep touching about real-time payment system, and the story that I started us off with about the woman, and Jonathan pointed out depositing her check. It got me angry because I remember starting in government when our goal was to get the unbanked into banks. If you could only get people low-cost bank accounts, you would transform their life. And here, you are seeing a person who has exactly that account being sent around the corner to cash their check to meet their real-time nature. And something that both of you said about real-time payment, something else the Bureau has done that I think is fantastic is this consumer complaint portal with the data. And when they did their deep dive in banks, one of the big findings from the Bureau was people were very upset about the email you get back saying your check has been approved for deposit, because you get that back in real time. Do you guys all do that where you get that email? People think that means that's where the money is. The money's there when you see your check has been approved. And no matter where in the fine print of the email it says subject to 2 to 3 days of delivery, blah, 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 that's not, you read approved and you say got you. And in fact, that's created a lot of complaints in the database. So I guess my kind of core question is, as Jonathan pointed out, I got a little bit passionate about this because it does anger me. Do you guys share the anger at the state of our real-time payment system? I mean, 2019, we're going to have an iPhone 10 before we have a payment system 2. I mean, do you think banks, are going to be able to fix this alone without waiting for the Fed and the government? Will government fix it, or will there be a group of fintech entrepreneurs on our panel or out in San Francisco in the Bay Area who are going to fix it where we wake up one day and we've been, payments have been Uberized? I mean, do you think it's going to be fintech, banks, or government, or none? Are we going to be stuck in this slow payment world for a while to come?
I don't think we're going to be stuck in the slow payment world for too much longer, because there is this process ongoing. So the payment. So the senator was talking about how long it took him to get his brain around the idea of blockchain. I'm still struggling with that. It is complicated, and you think about what essentially a payment system really means. It means that every actor in the economy is tied into this system, and it's a medium of exchange for all the banks, all the merchants. It's immense. So I think you're going to see You're going to see people coming at it from a lot of different ways. It may not help you at all, for example. So there's one group of large banks that's doing immediate funds availability, and that's great if you're in that. If you're have an account at one of those banks and the person you're paying has an account at one of those banks, it works, you're there. But everybody else has to get, it's got to be for everybody. So it's just I think this is a place where probably government has a central role to play, even if it's only as a referee.
Right.
But I do think you're going to have rules of the road that give access on a fair basis to all the players.
So I've been trying to stay away from predictions lately because I was convinced the Red Sox were going to the World Series. But I was definitely wrong there. But I think that it's probably an all of the above answer, right? We're not obviously decades away from the Fed's reaching conclusion with its work. I think they've done a great job pulling together lots of stakeholders and dealing with a fairly complex issue. In the meantime, there's products that are developed, right, that help solve for that, both on the banking side, as you think about the banks that are, they've been developing products and services to help you move money between banks a little bit faster, a little bit easier. And then you have the fintechs working on this as well with sort of workarounds or other products that get to the same end. So I think it's going to be sort of a combination, but hopefully we'll get there sooner rather than later.
I mean, I think one of the fundamental issues, I guess, is that we have incumbent payment rails, right? And that's the world we live in, right? And to rip all that infrastructure out of the ground and recreate it is prohibitively challenging, I think. So we have to work around the confines of the constraints that we have, which is why I think, Aaron, it's very hard to snap a finger and come up with a solution, and why no single type of entity can come up with a solution, because, as Jonathan said, it is so there are so many actors that are interconnected here. But I think there are pockets of really encouraging activity in each of these dimensions, right? So we talked about the government initiatives, the Fed's initiatives, the clearinghouse, which runs the chip system, and I think is the single largest private provider on the ACH system, is working very hard on a real-time payments and settlement system. In fact, they're going to pilot it not in 2019, but in the first quarter of 2017 is what they say. And that is very promising. I mean, that's real-time settlements and payment. Now, again, the reason why they can do that is they control that chip, that part of the infrastructure, right? So they have the ability to, on their system, to innovate. So I do think there are pockets of activity here, but I do, obviously we share your concern. I would say that to make a little bit of a technical point, there is law that covers your scenario, on the books. The Expedited Funds Availability Act, which is enforced through Reg CC, there's a whole set of criteria there, but generally it's overnight settlement. And when you don't have overnight settlement, which is based on a whole set of criteria, are you a habitual overdraft person? Is it over $5,000? Whatever. There's all this stuff. Then it'll take longer for your check to clear, and in that case, you still get a minimum. If it's over $5,000, you get $200 the next day, and so on and so forth. Anyway, there's
but
so.
It's a fair point. Yet the check was good. The woman could have been given the full amount or near to that, almost in real time. In my opinion, certainly with a less exposure to the bank. Now, their profit incentive is mixed in terms of their overdraft earnings if they deny her that. And in Reg Z, the Fed could also reduce the amount of time it's taken checks to clear, right? The only reason check clearing time has been reduced is because the number of check processing plants that the Fed ran was shrunk from 33 to 1. So now we all clear in one central zone. But that's still 2 days. They could have shrunk that. I guess to predict on my end, I think banks, either through the clearinghouse or otherwise, or fintech will innovate before government. I think one of those two will get there first. We'll see. The sooner the better for everybody. I guess in this role, let's broaden it out a bit about where you think government's role is as a partner for fintech. I mean, the three of you sit in three core positions, leading, kind of thinking through deeply government's interaction. Is government going to be a partner for fintech? Are they going to lead? Are they going to follow? Are they going to be a service provider? Like, what is going to be that kind of future of the government fintech partnership?
You can go first.
Should I go first? I think I tried to hit this a little earlier, right? I think government can facilitate, and it can also be a provider. At Treasury, we have set up what we call an innovation fund. It's actually called the Financial Empowerment Innovation Fund. And we have an appropriated amount of money through which we can actually fund really interesting research projects that are meant to foster innovation in payments and savings, right? And so that's one example where government can get involved. There's a really interesting case in this area. There's one grant that was given to an organization called Banking Up, which we'll talk about more. I think Treasury will sort of roll out a little bit at some point in the future, but it's a research project and it's a pilot project, and it's really about low-income consumers that have a very solid history of responsible spending and savings using prepaid debit cards, will then be issued credit cards. And a mobile app will be given to them to help them manage their debit and credit cards, and also to push out useful financial management suggestions, right? So this is the kind of thing that we are funding, right? It's small scale, it's a pilot, but the idea is to find innovative ways to actually get at some of the issues that we've been talking about today.
Yeah, I think one way I think about this is in sort of riffing on what Anjan said, is the facilitation point. But one of the things I really enjoy about my job is I can think about all these questions as it relates to fintech, but because the breadth of what we do is so expansive, if you think about what the president has done for innovation writ large, whether it's the Open Data Initiative, whether it's visas for entrepreneurs, Demo Day at the White House, which was all about inclusive entrepreneurship and bringing underrepresented groups into the fold. My favorite was there's a little group of 6-year-old Girl Scouts who invented a page turner for those who had sort of disabilities, and it was like made with Legos. It was very cute. But right, there's all these things that we don't necessarily think about as fostering innovation in the fintech space per se. But if you can set the stage for innovation more broadly through immigration policy, through opening the vast stores of government data and all these things, that will all ultimately help the fintech ecosystem among others. And so when you touch as many things as Treasury does or the White House does, being able to see the interaction between these different areas and making sure it's all sort of rowing in the same direction, I think is an incredibly powerful function.
I would just say the FDIC is a bank regulator and bank supervisor, so we have a little bit of a different function, I think, than Treasury and the White House. We really think about this in terms of the standards of the interaction between the fintech industry and FDIC insured, FDIC supervised banks.
Yeah, no, I think Adrian made the key kind of observation about the social contract, and in that I always think that a bank is a charter from the state or the federal government. It is not a license. And the social contract of a charter is somewhat different intellectually than that of a license. A license is a permission. A charter is fundamentally a state-sponsored thing, right? You probably know the legal history better than I do about where it goes back to the king or queen who could grant a charter. Right. I think the news that dropped on I think on Political Pro, or somebody dropped that one of your fellow regulators who actually does give charters is going to be putting out in November the idea, or some white paper. There have been conversations about fintech charters. So I think we're going to get back to this conversation, both from the social contract space, the Adrian space, the kind of role of the regulator and the charter giver that Jonathan points out, and fundamentally, as Anjan points out, the whole point of this is to grow the economy, right? I mean, the reason that we have fintech is so that people can use their money better, faster, smarter, gain access to credit, cheaper, wider, so that we can have kind of this entrepreneurial area. So I promised that we would be able to get out by 4:30 for everybody who wants to get to or home to watch the Nats game. I'll not give predictions on Game 5, but I've kind of monopolized your time and want to thank you all and thank everybody in the audience.
Thank you
for this wonderful conversation.